Good evening, class, and welcome to our performance management class. My name is Chimaroke, and this is our second class. In the first class, we learned about a, a kind of costing method called absorption costing. We learned that for us to get the full cost of a product, we need to know both the variable cost and the fixed cost. We learned that the variable costs, we have no issues in transferring the cost to the final product because variable costs, many times they are direct costs, and direct cost, also known as prime cost, is directly traceable to the final product. And so with with variable costs, there are no problems in getting the cost elements in the cost unit. Now, when it comes to fixed costs are those costs that are incurred in the period. We call them overhead. And so they are not directly traceable to the final product. And so because they are not traceable, instead of allocating them straight ahead to the final product, we do something called apportionment. And there are different ways this apportionment can be done. We've used the absorption costing method where we saw something fundamental that, first of all, we have to do direct allocation if it is possible. If it is not possible, we do apportionment using appropriate measure of apportionment. And we saw that there are certain departments that are service departments that are not product departments. We need to reapportion the service department into the product department so that we can get what each production department is charged. When that is done, we get the single cost, which is called overhead absorption cost or overhead absorption rate. That is the rate with which you will charge all other production departments based on their labor hours. Overhead absorption rate is the singular cost you will get, which will be used in charging the production department based on their labor hours. And so we find out that overhead absorption rate is something that is very useful for absorption costing. Now, when we get that, we also learned last week about something called over absorption and under absorption. And I mentioned that over absorption is like over budgeting. And I gave an example that suppose that I have planned for 7 people to be on this call, and I want to give each person 1,000 naira for dinner. 7 people, 1,000 naira each, now that's 7,000. And that is what I took as my budget, and I came with it. On coming to the class, I now found only 3 people in the class. And so how much will I spend? I'm going to spend 3,000. The remaining 4,000 is an over budget, over absorption. Now, supposing I came and I saw 10 people in the class, but I've planned for 7 people. That means I didn't budget enough. I have under budgeted. I have under absorbed. And that's where we ended for last time. Today, we are going to be looking at activity-based costing as an alternative to absorption costing. Now, both of them are costing method, and the aim of each of them is to evaluate the fixed costs. Activity-based costing is a modern method of costing. Why is it a modern method? Because absorption is older method and is also called traditional method. All right. Now, absorption costing relies on common sense and judgment to allocate overheads, which we call arbitrary method. The common sense method is arbitrary, whereas the activity-based costing is using a more correct method, which is based on something called cost drivers. These cost drivers is like, what is it that drives costs? It's an activity. For example, you wouldn't pay me to be in my PM class if there will be no activity. Activity, which is teaching, will drive the cost, which is passed on to you. So activities, rather than rather than being a manager or a department, drives the cost. In absorption costing, cost units such as departments or managers are what is used as a basis for charging costs to the product. So it means that because I am a HOD or the manager for PM, it means that cost has been incurred for having the department called PM. But it doesn't take into cognizance whether there was activity or not. Just because there is a department for PM, cost is incurred. But activity-based costing, it doesn't care the department, it looks at the activities. So you can say that while absorption costing uses noun, a noun is a place, animal, things, name of a person, animal, place, or thing. That is a noun. Absorption cost used nouns. Activity based, action words, verbs. Let's look at the formula which is used for activity based costing. Now, it is called cost driver rate. Now, the formula for cost driver rate is the total cost for each cost pool divided by the budgeted level of activity for each cost driver. Now, this means that if there are 4 activities, there will be 4 cost pools, there will be 4 cost driver rates. I call it CDR. There will be 4 CDRs to match the number of activities. Now, in absorption costing, we only had one overhead absorption rate, which takes into consideration the total overhead divided by the total labor hours. The cost driver rate is an adaptation of the overhead absorption rate, but because the costs have been divided into activities, you take the cost for each activity, divide it by the budgeted activity for level of activity for that driver, meaning that for overhead absorption, for over absorption costing method, there is only one thing that drives cost, which is labor hours. But for activity-based costing, there may be more than one thing driving the cost. Now let's look at diagram 1.3. This shows the direct allocation of variable costs using activity-based costing. This is the same way we treated in absorption cost. Look at a bakery that wants to make a bread. They have flour, they have butter. These are direct materials. You can trace butter and flour to the bread or cake, which is the final product. So it's a direct allocation of cost. Now, the skilled labors, we have direct labor, which we find out that the skills of the laborers, if there are more skilled labor, you see it in the bread. The quality of the bread will be good, the price will be high because the cost is high. If there are unskilled, mainly unskilled, we find out that the cost will be low and the finishing might just be low. You cannot compare aggregate bread with bread that they sell in ShopRite and other big supermarkets. The difference is clear, both the material and the labor. These are all traceable to the final product. The same way we did in absorption costing is the same way we handle in activity-based costing. So the difference now lies in the way overhead is treated. Now, how is overhead treated? Now, absorption costing, we said, use overhead absorption rate, whereas activity-based costing use cost driver rates. Now, there is always a halfway house between the, the cost item and the final product. First of all, there is an indirect absorption of the fixed cost. Let's say there is a factory rent or depreciation of factory machine. Before it will get to the final product, it will first of all be trapped by the activities. Some of these activities could be machine setup, it could be invoicing. All of these are activities. And it is these activities when we have used our cost driver rate, we will channel it from the activity to the final product. Unlike absorption costing, where we will get to a manager or a department and will now use our overhead absorption rates to channel it to the final product. Now, we said before, these are important points you should note in this point number 1 and point number 2. I've mentioned them, the noun and the verbs, and the one rate for absorption and the several rates for activity-based costing. Now let's look at some examples of activity-based costing. All right, so for those who missed the absorption costing, this is another way, another opportunity to get to learn it. All right, Danfo Company makes and sell two products, X and Y. Now the data for production and sales each month are as follows. So we have sales demand, For product X, we have 4,000 units. For product Y, we have 8,000 units. For direct material, the cost is 20 naira for X, 10 naira for Y. For direct labor per, per unit, for direct labor hours per unit, this is labor hours per unit, 0.1 hours is used to make 1 unit. What is 0.1 hours? If you multiply it by 60, what would that give me? Let's see whether we can get this thing in minutes. 0.1 0.1 multiply by 60. It is like 6 minutes. So 0.1 hours is as good as saying 6 minutes. That is what it means. So this is for 1 unit, we have it 0.1 hours. If you like to leave it in hours, it's fine. If you want to convert it to minutes, it's fine. For product Y, 0.2 hours is as good as saying 12 minutes. Now, direct labor costs. We have 2 naira for X and 4 naira for Y. Now, all these things here, starting from direct material, direct labor, these two things here are for variable costs. If you go down, you say production overheads. So we underline this word overhead. Overhead is the issue. Overheads, these are 5,000 naira each month. 5,000 naira each month. So that's it. Overheads are 5,000 naira each month. Sorry, I need to clean up this thing. Now, 5,000 naira overhead each month. And now we are told that an analysis of the overhead suggests that there are 4 main activities. So these are the activity. This is the first activity here. The second activity is this one here. This is the third activity. And this is the last activity. So all these are the activities. And now you can see the 500,000, which is the labor, which is the overhead expenses, that is the same with what they told you here. We are told that this overhead is 500 each month, and that's the overhead here. Now you can see the cost drivers. Look at the activities that drive the cost here, 4 of them. Look at the cost drivers. Look at the total number of level of activity of the cost drivers. So for number of setups, we have 20 as the total. For order handling, we have how many there? We have 40. Machine hours. How many machine hours do we have? We have 15,000. And number of checks, how many did we have? We have 32. So that's what we do here. Okay. Now, it means that for product X, for setup, product X brought 10, product Y brought 10. For order handling, product X brought 24, product Y brought 16. When you add them together, it gives you 40. The same thing with machining, product X is 6,000, product Y 9,000. Then for number of checks, 18 plus 14 will give us 32. Then we are asked, required, calculate the full production cost. for X and Y. When they say the full production cost, it means you need to give them the variable cost and the fixed cost. Using absorption costing method, which is absorbing production overhead on a direct labor hour basis. So this is a direct labor hour basis. That is for absorption costing. Absorption costing is based on direct labor hours. Direct labor hours. Whereas activity-based costing is based on the cost drivers. So we've seen the question now. So let's get down to the solution. We have a prepared solution here. So we'll try to explain this solution. Now look at the A part of the question. The A part of this question, we have our sales units. In the question, we are given the sales unit already. We have 4,000 and we have 8,000, just the way it was given to us here. All right. Then direct material cost. We are told that direct material costs 20 naira for 1 unit. So this is cost per unit. Cost per unit. So it's 20 naira for 1 unit. If 1 unit costs 20 naira, that will mean that 4,000 units will cost 80,000. So you see here, total direct material is same thing as A multiplied by B. A multiplied by B. The same thing with product Y. If the cost per unit is 10 naira and we have 8,000, it then means that the total cost for material Y is 80,000. That's one down. Now, when we add 80,000 to 80,000, we have 160,000. This 160,000 is just for material costs. Now, let's go to direct labor. We were told that direct labor cost per unit is 2 naira and 4 naira. That's it here. 2 naira and 4 naira. So it means that direct labor cost per unit, if 1 unit costs us 2 naira, 4,000 units will cost us 8,000 naira. If 1 unit costs us 4 naira, 8,000 units will cost us 34 naira. So 8 plus 34 gives us 40,000 naira for direct labor cost. Now, when we have this 40,000 and we add it to this 160, it gives us 200. So it means that your total variable cost or total prime cost, the prime cost is 200,000. If we were to look at it critically, we can also get it here. This is the total material cost, 80,000. Total labor cost for product X, 8,000, gives us 88,000. Going to product Y, material cost is 80,000, labor cost is 32,000. Add them together, you have 112. When you have 112 plus 88, that gives us 200,000. So 200,000 is the total variable overhead cost. What about the fixed cost? The fixed cost is where we need workings. Now look at the workings. We said for absorption costing, we need overhead absorption rate. So what is the total overhead? The total overhead here is 500,000. So that's why we have 500,000, then divided by labor hours. Now this is direct labor hours. They are giving just the rate for one. We are giving the rate for one. So this is what we will do for us to do the total hours. We said 0.1, 0.1, 0.1 is in hours, 0.1 hours is required to make 1 unit. And we made 4,000 units. So I multiplied by 4,000. That means I have 400 hours. 400 hours to make 4,000. All right. Then for product Y, 0.2, 0.2 hours for 1 unit. So when we make 8,000 units, this is 1,600 hours for product Y. So when we add this 1,600 plus 400, we have 2,000 hours for the whole product. And so that's what we got here. So what we did here, we have not done. We have here 2,000 hours, right? 2,000 hours is the total hours. But we want to look for overhead absorption rate. So it should be 500,000 naira for the whole overhead divided by 2,000 hours. Meaning that for 1 hour, we are having 250 naira. That means the overhead absorption rate is 250 naira for 1 hour. And that's what we have here, 250 naira per direct labor hours. All right. Now that we know that is 250 naira for 1 labor hour, what is the labor hours for product X? We said before we have 0.1 as the labor cost multiplied by how many units? 4,000. And we have 400 hours for, we have 400 hours for product X. So what do? We'll simply multiply it by 250,000, and that will give us 100,000. So that's this 100,000 we saw here, 100,000. Now for product Y, we said they have 0.2, let me confirm, 0.2 hours per unit, and we multiply it by 8,000, and we got 1,600 hours. What do? We multiply this by that 250, which is 400 hours. Now that's this 400 hours we have here. So when we add 400 plus 100,000, we get 500 as a total that we had before. 500 was the total, and look at how it was allocated to the each of the products. So it means that the full cost will be 88 thousand, which is the prime cost, plus the 100,000, which is the overhead, gives us 188. Here, the prime cost was 124, 112, sorry, while the overhead is 400,000, which gives us 512. And of course, for the total, it is 700 for the whole cost. Now, this is the absorption costing method. Very direct, very straight, no issues. Now, let's see the, the B part, which is the activity-based costing. Now, the sales demand is 4,000 and 8,000. The prime cost is the same thing we did in part A. So we're just bringing it down. No need to no need to carry it further, because if you look at it here, it is this same thing that we had. It's this same thing that we had here that we are carrying down here. So that's the same thing. Now it is the overhead that needs your attention. Now in the overhead, what do? We need to look at the activities that control the cost. And so this is what we did here. We said these are the activities 1 to 4 here. Look at their cost drivers, which was also given. Now their cost driver rate. How did we get these figures? This is how we did the cost driver rate. Look at cost driver rate for setup. Setup has 100,000. That's the total cost of setup. Then look at the total number of activity for setup. So you simply say 100,000 divided by 20. That gives us 5,000. So the first one is done, 5,000. Now that's done. The second one is 200,000 200,000 divided by, what are we dividing it by? Divided by 40. Divided by 40. And that gives us another 5,000. That's the second 5,000 of this CDR. The third one here is machining. We have our 120 divided by 15,000. That's 8. That's what we have here, 8 naira. Then we'll go to the next one. 80,000 for daily control. 80,000 divided by 32 checks. And we have 2,500. That's how we got these figures here. How did we get these figures here, here, and here? Okay. Now, when we get this CDR of 5,000, we use it to multiply the cost driver at the product level. So we had 5,000 here, first instance, 5,000 multiplied by 10, which is for product X. Multiplied by product X, 10. Sorry, multiplied by 10 gives you 50,000. So both case A and B give you 50,000. That's what it's showing here. Right, so the next one, we have 5,000 again, multiplied by what? The cost driver here is 24 and then 16. So 5,000 times 24 gives 120. 5,000 times 16. I'm multiplying by 16 here, and that gives me 80,000. So that's the 80,000, and that's the 120. We go to machine. Machine, we had 8 naira. And what do we do with the 8 naira? 8 naira multiplied by 6,000. That's 48,000. Where 8,000 divided by 9,000, 8 divided by 9,000, 8 divided by 9,000. That's 72. That's the 72 we got here. And the last one here, we had 2005 multiplied by 32. We have our 80,000. So we have our 25 again times 14. That gives us 35. That's the 35 we have here. So this total here, when you total these two together, you have this. Total these two, you have this. And mind you, this 100,000 here is corresponding to this 100,000. This 200,000 is corresponding with this, such that when you add everything here, you have 500. So what do you need to do? These two figures, you bring them up. Okay, look at the total figures. Is this total figures that you need? This and this 500,000 here. That is what is being used here. And when you add them together, you are having this of this. Now the thing is this: if we were to compare the absorption costing method, you have 200 as the prime cost, 500 as the overhead, 700 total cost. In the total terms, it is the same thing. 200, 500, 700. It's the same cost. But look at each of the products. For activity-based costing, product X is giving 351,000, whereas here is giving 188,000. In the activity-based costing, product Y is giving this amount, whereas in absorption costing it is getting 512. So the question is, which of these two is better? None is better than the other. It's just a way of realigning your costs. You see here that in activity-based costing, it favored product Y, because in uh, in absorption costing, product Y was absorbing 512, but here it's absorbing 341. Whereas this activity-based costing does not favor absorption, does not favor product X. Look at why it's absorbing 351, unlike 188. So Both of them, as long as it gives you 700, the company is spending a total of 700, but it's now left on how each of the product is absorbing it. So it means that one product may be costlier than the other using any of the method. So that's it for the two method. So if you look at it here, let's give a summary of what we have done in absorption costing and activity-based costing. One, we have looked at absorption costing as a traditional method of dealing with overheads, and it involves three stages. We call it the three A's: allocation, whereby you know where each cost is to each department directly without argument. Apportionment, you have basis of apportionment which you use your common sense and judgment. And then you have the absorption, whereas you use the absorption overhead absorption rate in absorbing them. The second thing we learned is that allocation is done directly to the affected department. Apportionment is done using suitable basis. Absorption is done after apportionment using OAR. We learned about the over-absorption and under-absorption when overhead incurred does not equal to the overhead budgeted or expected or absorbed. We said absorption costing uses direct labor hours or machine hours, but most times it's direct labor hours. That is the main level of activity, and it is what is being used to look for your OAR. Whereas activity-based costing use cost driver rates for each cost pool to find the suitable rates to use to absorb the overheads of the final product. We also said that ABC is a more modern method to use to deal with overheads, and it is more accurate than absorption costing. Now, both absorption costing and activity-based costing are approaches used in dealing with full cost. So some of the assignments I'm going to be giving to you is going to come from the ICANN study pack. It's going to come from, let me check if I can get some of these things here, which I can send as part of what we are going to use as assignment here. This is ICANN study pack. Let me go and search for modern techniques. Okay, now we have one of them here, activity-based costing. You should know that our principal material here is the ICANN study pack. So we'll be using it much more. So I would like you to also look at this example and look at this example using what I have done here to understand this. I'm looking for an example where you will have to solve. You can also look at these examples based on what I've told us here, and you can solve this. Okay, so I'm going to look for a question on that. Let me see. These are operational statements. Okay, as modern management technique. Okay, let me go for absorption costing and see if I can get absorption. Absorption costing. So let's right. Now look at absorption costing. Let's see whether there are some questions you can get that you can solve. Then you get to pass questions. Okay, so this is a look at absorption costing. We'll come to comparing it with marginal costing, but you need to go to past questions. I will send you past questions as a message for you to do that as an assignment to be submitted. All right, now that we are done with absorption costing and activity based costing, I want us to, at this time, take a minute to ask question. So let's ask question before we move to the second half of today's lecture. So for the next 1 minute, let's see whether we have a question to ask. All right, I see that there is no question. We now go to the next topic, which is called marginal costing versus absorption costing. Okay, I'm seeing a question. Somebody is saying that in the last lecture I mentioned that absorption costing, there's apportionment, reapportionment, and absorption. But now I'm saying allocation. The allocation is for the variable costs, and those ones that has already been apportioned. Like if you see the example they gave where we have indirect material, did you see that we didn't do anything about it? It has been allocated already. That has been allocated already. Then we now said there is reapportionment. Reapportionment has to do with apportionment and reapportionment. Okay, we have apportionment, and in that apportionment you can reapportion if there are other service departments. It's not in all cases you have service department, but in this context, when I said apportionment, I also mean reapportionment too. Then we have absorption. So it's not that you can use them interchangeably. Allocation simply means when you know the department that has that cost, take it to there. Apportionment has to do with sensible ways of dealing with these costs. Reapportion is the ones that is not supposed to be giving costs. Take it from them, reapportion. Then absorb. You use the absorption rate or you use the cost driver rate. I believe that is fine for now. We now want to go to the second topic here, which is marginal costing versus absorption costing. Our main focus in this lecture is to talk about marginal costing as an alternative to absorption costing. Now we shall contrast the use of marginal costing and absorption costing when writing the profit statement or income statement. Now, before I go on, absorption costing is what is mainly used in determining full cost, even though we say ABC is more accurate. Absorption costing is easier to apply. ABC is a bit complex, especially if you want to look at cost driver rates and other things to set it up. So most times we use absorption costing. So now we are looking at absorption costing with marginal costing. What are their similarities? What are their differences? Now let's talk about marginal cost. What is a marginal cost? The marginal cost of an item is its variable cost. So another way of calling variable cost is to call it marginal cost. Now, it means that we can have marginal production cost. Marginal production cost is those costs that we use in production that are variable. So we have direct materials. They are used in production, they are variable. We have direct labor, we have direct expenses. Then we also have variable production overhead. There are some overheads that are variable in nature. So it's not all overhead that is fixed. So in case that you have a semi-fixed cost, in a semi-fixed cost, there is a variable part and there is a fixed part. And so it is that variable part that is included in the marginal cost. Now, when we have marginal production cost, we can also have something called marginal cost of sale. Generally, what is cost of sales? Cost of sales is simply your your sales minus your production cost or your cost of sales. Your marginal cost of sales, not profit. Marginal cost of sales is your direct material, direct labor, direct expenses, and all your overheads that are variable in nature. All of these things forms your marginal cost of sales. Normally, the normal cost of sales, you have to bring every cost, both variable and fixed, that you incur for the purpose of this sale. Those ones could be called your normal cost of sales. But when we come for marginal, you need to bring out those ones that are variable in nature and leave out the fixed cost. Then when we come to marginal cost of sales for a service, that means you only have the direct material, direct labor, direct expenses, and variable overhead. You will not see production overhead. So we are talking about marginal. Everything we'll be looking at is variable. Variable. You'll be stripping out variable cost from fixed cost. They will not be joined together. That is your aim for marginal cost. Now, what are some of the uses of marginal cost? One of the uses is that it is a measure of profit and loss, which is an alternative to using absorption cost. You can forecast with marginal costing what your future profit will be. For example, in break-even analysis or cost volume profit analysis, you can use it to know if you have broken even. You can use it to know what your future profit will be. You can also use it to calculate the minimum sales volume that you must have to make a profit. Let's say, for example, you are a lecturer here, you'll be using it to know what is the minimum number of students I would have in order to make profits. So you can use it for forecasting purposes. Yeah, it's flexible. You can use it for a lot of things. And it is because of that marginal costing method is very widely used in performance management. They're used for budgeting, forecasting, planning, decision making. And these are some of the things you'll be doing a lot in your performance management class. Now, what are some of the assumptions we will use in marginal costing? First assumption is that every additional unit of output or unit of sale has the same variable cost. In other words, the variable cost is constant. Variable cost per unit is constant. What it means is that if I am selling my bread 100 naira per unit and I've sold 5 units, 5 times 100 is 500. An additional sale will make me have 600 naira, right? It means that my variable cost per unit is constant at 100. Take note, variable cost per unit is constant. Second assumption, fixed cost. Now, not in per unit, but fixed cost in total terms is constant, regardless of how many units you are producing and selling. Take note, variable cost is constant only in per unit. Fixed cost is constant only in total terms. If you know these two principles, marginal costing will have been half solved. Now that we know this principle, let's look at another one here. Costs are either fixed or variable, or they can be a mixture of fixed and variable costs, because we have mixed cost which is semi-variable, and mixed costs can be separated into their variable cost component and fixed cost component per period. So that is known. The marginal cost of an item is therefore the extra cost that will be incurred by making and selling one extra unit of the item. Therefore, marginal cost is particularly important for decision making. You will see decision making in make or buy decisions, in shut down decisions, linear programming. You'll see it in All right. Can someone confirm that you can see my notes and you can hear me?
No, sir.
Okay. I believe now that my notes can be seen and I can be heard. All right. Now, contribution is okay. All right. You can see me, you can hear me. That's good. Contribution is a very key concept here. What is contribution? Contribution is simply sales, sales minus variable costs. So when you minus your variable cost from your sales, you have contribution. So it's as simple as that. Now, you can break it down to contribution per unit. Now, when it is contribution per unit, it means that your sales will be per unit and your variable cost will be per unit. All right? Then there's another way of getting contribution. You can have your total contribution to become there's another way to get total contribution. This is total contribution. We know that total contribution plus minus your fixed cost. If you minus your fixed cost from your contribution, you are getting a profit. But if you turn it the other way, if you add your fixed costs to your profit, you get back total contribution. So, but you see here that once you have a total contribution, if you minus your fixed cost from it, that is when you are going to be making profit. So, every organization, they are not looking at how to make profit first, they are looking of how to increase their contribution. Because as we learned before, fixed costs are unavoidable costs, whereas variable costs are avoidable. They can be controlled. Fixed costs, you may have no control over it. So when you increase your contribution, you have controlled your variable costs by reducing them as much as possible or by increasing your sales as much as possible. But your fixed cost remains stagnant. Now, when you've gotten total contribution and you minus your fixed costs, if you make a profit, then it's fine. If your contribution is enough to cover your fixed costs, then you've made a profit. Then any other contribution that you are making, maybe you increase your sales price or you increase your sales volume, you'll be having more profits. Because once your total contribution has covered your fixed cost, any other thing that you make is profit. But if your contribution fails to cover a fixed cost, then you'll be making loss. All right, so now we need to report financial reports using marginal costing. Now, how can we use the marginal costing to write our financial report? Now, profit is measured by comparing revenue to the cost of goods sold in a period. When we calculate the cost of goods and minus it from revenue, we have a gross profit. Then we deduct from other expenses, right? Normally we get our net profit. The cost of goods sold is the total cost of all production costs in the period adjusted for the inventory movement. What they mean by inventory movement, that is opening stock and closing stock. In marginal costing system, the opening stock and closing stock is measured at marginal cost. The cost per unit only includes variable cost of production, which are direct costs, direct expenses, variable overhead. We're going to see that as we walk along. When measuring profit using marginal costing, it is usual to identify something called contribution and then subtract fixed costs from the total contribution. For example, we have sales. This is our sales figure 360. Fine. Then we have our direct costs. Now, this direct cost could be direct material, direct labor, direct expenses. All of this gives you 105. Then you now have variable production costs. These are still marginal costs. Then we come to variable selling and distribution costs. We can never have variable admin costs. Admin cost is always fixed. So we can never have variable admin costs. So when you add all these three together, you are now having 130 as our total marginal cost. They are marginal costs in the sense that they are all variable in nature. When you remove this marginal cost from the sales, you have contribution. So note here, sales, total sales minus your total marginal cost or your total variable cost gives you total contribution. Now you are asking yourself, is this contribution enough to cover my fixed cost? Now this is total fixed cost. It could be total admin costs, which is always fixed in nature. It could also include fixed production costs, fixed sales and distribution costs. All of this is covered here, 150, and your profit is 80,000. This is just an example, like a format. Now let's look at something here, total contribution and contribution per unit. In marginal costing, it is assumed that the variable cost per unit of a product or of a service is constant. Remember that assumption we said before? The variable cost is constant. If the selling price per unit is also constant, it means that contribution that you earn for selling one item is also constant. Let's look at it again. We said variable cost is assumed to be constant. Let's say the variable cost of making bread happens to be 200 naira. It is constant. And if we decide to sell our bread 500 naira and that price is constant, it is constant. So when we sell each bread for 500, note that we have used 200 naira as variable cost for that bread. And when we less it from the cost, our contribution is 300. So if your variable cost is constant, your price is constant, your contribution will be constant. So therefore, if contribution per unit is constant, we can get total contribution by multiplying contribution per unit with the total number of sales. So in other words, if you want to know your total contribution for selling 1,000 loaves of bread, all you need to do is, how much contribution did I make for one? 300. Since my price is constant, my variable cost was constant, that 300 will be constant. 300 times 1000 will be 300,000. That will be my total contribution. Now look at example 2 here. A company manufactures and sells two products, A and B. Product A has a variable cost of 6 naira and it sells for 10 naira. That's the selling price. Product B has a variable cost of 8 naira and sells for 15 naira. During this period, the period, 20,000 units of product A and 30,000 units of product B were sold. Fixed costs were 260,000. Now required, what was the profit or loss for the period? What was the profit? What was the loss? Let's see how we can solve this question. What was the profit? What was the loss? Now, if you see it here, that's a question. The marginal costing, I think that's a question for you to solve. It's an assignment for you. So all you need to do here is, we can still look at it together. We can look at product A. How can we get for product A? We simply say product A, the variable cost is 6 naira, whereas the selling price is how much? 10 naira. 10 naira minus 6 naira will give us 4 naira. 4 naira is the contribution made by product A. Now, when we have the contribution, how many units of product A was sold? Product A, we have 30,000 units. So I'm going to multiply it by 30,000 units. It means that product A had a total contribution of 120,000. Let me store it in my memory. 120,000. Now, product B. Product B sells for 15 naira and the variable cost is 8 naira. All right? That means 7 naira is my contribution. And how many units of product B was sold times 30? Oh, product A was 20,000. Okay, let's do product B first. 30,000 times 7, which is 210,000. 210,000 is the total contribution for product A, or for product B. Whereas, look at the contribution of product A times 20,000. That's 80,000 for product A plus, okay, what am I doing here? Clear this. 80,000 plus 210,000 for product B. That's 290,000. 290,000 is the total contribution made in the period. And we have fixed costs of 260. We remove 260. That means we have 30,000 as our profit for the period. So you see how we have used the marginal costing method. We'll first of all look for the contribution, look for total contribution, and then look at removing fixed costs from the total contribution to see whether we've made a profit. Now let's look at marginal costing income statement with opening and closing inventory. Now, in absorption costing, the production cost of sales normally is calculated as we have our opening stock, then we have to add our production cost for the period, then we less the closing stock. Whatever we have is our production cost of sales. We use the same method for marginal cost. We will now say marginal cost of sales is opening inventory or opening cost, which is at marginal cost calculation. Then instead of bringing production cost, we'll bring only the variable production costs. Then we'll do the closing inventory, which is also going to be marginal in nature. All right, let's look at example 3 here. Look at the marginal cost here. Look at sales, 440. Opening inventory at marginal production cost is going to be 5,000. Variable production costs. Now you start outlining them. Direct material is one of them. Direct labor, variable production overhead. And look at their figures. You add them up and you have 110,000. Remember, there's variable opening stock here. Now you need to bring your variable closing stock. And when you less your variable closing stock, you have variable production cost of sales at 112, because this is your cost of sales, variable. Now we need to bring our variable selling and distribution cost, 18,000. When you add it to 102, you have your total variable cost of sales. It's different from production cost of sales. Production is only production. So when you add selling and distribution, it becomes total variable cost of sales. You have 120. When you remove 120 from the sales, your contribution is 320. Then you now bring your fixed costs. You need to bring your production fixed costs. Of course, we have it as it's supposed to be under here. Sorry for shifting. 120. Then your admin cost is always 100% fixed. They're supposed to be under this first Naira sign. Then your selling and distribution fixed cost. When you add these three, 120 plus 70 plus 290 plus 90 rather, you have 280 as your total fixed cost. It is this 280 that you remove from 320 to get 40 as your profit. So that's it. This is a marginal income statement. How is it marginal? Because of two things. You have separated your costs in terms of variable and fixed. So it becomes marginal. Secondly, you can identify contribution. So the aim of marginal costing is to get contribution. Once that is done, your aim has been achieved. All right. Now look at example 4. If an income statement is prepared using absorption costs, the opening and closing inventory would be like this. Now, this one we want to do here now is absorption costing, which is not marginal. Now, let's see how different it is. Now, we still have our sales here, but you see, this sales, okay, it's not the same. Let's not compare. This sales is 430, but now your opening inventory is at full cost. There is variable cost there. there is fixed cost there. Your production cost, your direct materials is always variable, direct labor is always variable. Your production overhead here, you can have both variable and fixed. That is what have this 100. When you add all of this, you have 198. Then you less your closing stock. This closing stock has both variable and fixed. You less it. Then you have your full production cost of sales. You have 184,000. When you minus your sales from your full production cost, you have 246,000. This is supposed to be your gross profit or your profit from production. Okay? Now there's another thing you need to know. Production overhead absorbed. It means that this is what you have budgeted. This is this 100,000 here. This 100,000 is what you budgeted, and that is what is here, budgeted. But how much did you actually spend? Because it is the budgeted that entered your book. How much did you incur? You incur 5,000. That means you have over budgeted. You have over absorbed. So this 5,000 is over absorption here. So when you add your over absorption, you have 251,000. This over absorbed, that 5,000 naira is added to it. So this is 251. When you now bring your selling and distribution cost, you less it and you have a profit of 73 naira. So it's only in absorption that you can see things like over absorption and under absorption. In marginal, you cannot see over marginalized or under marginalized. No, that is not the case. It's only fixed cost that you can do that way. All right, now let's look at calculation of marginal cost profit. Now let's look at this example. Example 5 will help us to understand this for a single unit, for a single product. Now in this example, we are given a selling price of, for marketing manufacturing, we are given a selling price of 150. Variable costs, we have direct material, direct labor, variable production overhead. When you add all these together, we use 70 naira, which is marginal cost per unit. Now they said something here, used in inventory valuation. What it means is that our opening stock and our closing stock will be based on this. Budgeted fixed production overhead is 110,000 naira each month. That is what you have budgeted for each month. Now for the following data, these are actual data for July and August. Fixed production costs for July and August, 110 as you have budgeted. These are actual data. Production units. In July, you produced 2,000. And in July, you sold 1,500. Now, assuming that there is no opening stock, okay, there was no opening stock in July. That is what I'm trying to say. If there is no opening stock in July, it means that your opening stock is 0. Then you produced 2,000 units in July and you sold 1,500 units in July. Your closing stock for July will be 500, which means closing stock for July 500, opening stock for August will be 500. Now you have opening stock for August 500, you now produced 2,500 in August, and you now sold 3,000 in August. Closing stock is zero. That's what we just achieved. Closing stock is zero. So opening stock for July is zero. Closing stock for August is zero. That means everything that was produced in July and August were all sold. Now, in this case, they said show the profit statement for each month using marginal costing method. All right, now let's look at marginal costing method. Let's get a separate one for the solution. Okay, so let's use this for solution. Let's use this for question. All right, so this is the question. Let's keep it this way. All right, now for the solution. Wow, I thought I had the solution here. Sorry. So we are going to be solving it here by ourselves. All right, so let's solve. So what do we do now? Opening stock. Opening stock. Opening stock is 0 naira. So there is no opening stock for July. No opening stock. So what do we do? Opening stock is 0. We want to get our variable costs. So how do we get our variable costs? Our direct material, direct labor, direct variable production overhead, we have 70 naira per unit. So what happened is this: we produced 2,000 units. So we simply say 70 multiplied by 2,000 units. This gives us our cost, but we need to remove the closing stock. This is production cost, production variable cost, but it's not complete if we have not removed our closing stock. Our closing stock we learned before was 500 units. 500 units. Okay, because we produced 2,000 and we sold 1,005. So we'll say 500 multiplied by 70. That will give me 35. So I will need to remove this 35 from 140,000. That means I have 105 as my production cost of sales. So there is no production variable overhead. There's no production sales and distribution cost. So this 105 is what is going to be our cost of sales, 105. So let's memorize it here, 105. Then our selling price is 150. Our selling price is 150. How many did we sell? We sell 1,005 multiplied by 1,005. That means we have 225. 225 minus 105. Minus 105. It means 120,000 is our contribution. 120,000 is our contribution. Then what do? We remove our fixed costs. Our fixed costs for that month minus 110. That means for July, our profit for July is 10,000. All right. Now let's go to August. In August, we already have an opening stock, which was the closing stock of July, 500 multiplied by 70, and it gives us 35. Let us memorize it. 35,000. Now in August, we produced 2,500 units. So look at the cost per unit, multiplied by 7, by 70. So we'll come here, 2,500 produced multiplied by 70. This is your production cost, 175,000. Now let's add our opening stock. 175. Let me clear the memory here. 175, no, 175, yes, plus 175,000. Is it 175 we got? Let's do it again. 2,500 multiplied, what's happening? 2,500 multiplied by 70, that's 175. Now you add your 35,000, which is the closing stock. 210. This 210 happens to be our production cost. Opening stock, closing stock, we dealt with that. Now, how many did we sell? 3,000 units. 3,000 units multiplied by 150, and that gives us 450,000. When we minus it from whatever was our cost, 210,000 was our cost, our variable cost rather, not cost, variable cost, we have a contribution of 240. When we remove our fixed cost from this, we have 130,000 as our profit for that month. Now that's how we do it. Remember, you have to bring your variable cost, and you have to make sure your opening costs and your opening inventory and your closing inventory are variable in nature. So that's it. In example 6, we are doing the same thing in example 6, but now we have been told something. It's the same 150, there is 35 naira, everything here gives me this 70 here. But now there is a fixed overhead per unit added to it, 50. Now total absorption cost now used in inventory is 120. Normal production, okay, somebody is asking a question. Someone said, I think we need something like a board for writing, sir. Yes, I would have gotten my prepared answers here, but I didn't know that this one didn't contain. And I'm also thinking of using a writing board. Yes, I will need to get a writing pen for that. I'm working on that. Sorry, but for now we are using the calculator. Maybe by next week or so, we'll have our writing pen, so that we will use that in our class. All right, so In this question here, this 120 will be used for valuation. Normal production units for the month is 2,200 for every month. Normal production. Now, it is based on this 220 that we got this 50. Normal production unit is 2,200 per month. Budgeted fixed production overhead happens to be 110,000 per month, which is given to us here, divided by the 220 production you budgeted for the month. That is what you got, 50. Now you've gotten your fixed cost that you are using. Now it doesn't matter how many units you eventually produced. It doesn't matter. Now, given the same scenario, how do we show the marginal costing method? All right, so let's use the same method we did before. Okay, now our opening stock in July is 0, and costs, our cost for the production happens to be 120,000. If you like, you can do direct material cost, 35 times 2,000. Labor cost, 25 times 2,000. Variable overhead, 10 times 2,000. You can do all of that. But a quicker way is to just take this 120 multiplied by production units, 2,000. That gives us 240,000. Now 240,000 happen to be your total. Now you need to remove your closing stock. Now your closing stock happens to be 500, because you didn't sell everything. 500 remaining, multiplied now by 120, because it's used for valuation. You have 60,000. So 240,000 minus 60,000, it gives us 180. 180 is our production cost. You don't call it variable cost because a fixed cost element is included. Remember, this 50 is a fixed cost element. So this 180 is our production cost of sales. Now we'll need to remove it from the sales. We sold this 180 now, right? 150 multiplied by 1,500. We have 225. When we remove 180 from it, we are getting 45. 45 will now be our profit. It will not be our gross profit, because our sales was 225, our production cost is 180, our profit is 45. Now when we remove our fixed cost here, which is not used in production, no, this is the profit 45. This is the profit 45, because don't make the mistake of come and remove this 110. This 110 is what we used in arriving at this 50. So this 50 is as good as this 110. So our profit here is 45 in July. Now let's go to August. In August, we have our opening stock of 500 multiplied by 120, which is 60,000. Then what happened? 120 multiplied by what was produced in July, 2,500. That's 300. 300 plus 60,000 gives us 360. There is no closing stock. So 360 becomes your 360 now becomes your what? Your production cost. Now how much is your sales value? We have 150 multiplied by 3,000. That gives you 450. So when you minus 360 from it, you have 90,000 as your profits. So you can see the different methods used in marginal costing, different method used in absorption costing. Later, as part of what I will send to you tomorrow or so, I will still have to solve this question and send it to you as a separate sheet so that you can appreciate it, because we know that here we only use calculator, but you may need to be looking at it again. Now, what's the difference between profit in the marginal costing and profit in the absorption costing? The profit for an accounting period, which is calculated using marginal profits or marginal costing, is different from those with absorption costing. The difference is due to differences in valuation method. In marginal costing, we use marginal costing. Remember, in that example, we use 70 naira, but as in absorption costing, we use 120. That's the difference in the valuation. So the opening inventory contains fixed production overhead that was incurred last period. Opening inventory is written off against profit in the current period. Therefore, part of the previous period's cost is now entering the current period and is affecting the statement. That's one. Closing inventory contains fixed production overhead that was incurred in this period. Therefore, this amount is not written off in the current income statement, but is carried to the next period. So you see, closing inventory is not written off in current period. It becomes opening cost in the next period. So closing inventory not written off in current period, taken to the next period to go and write it off. The implication of this is as follows. We assume that cost per unit remain constant when there is no change in the opening stock or closing stock. We will get the same profit using marginal and assumption costing. So if there's no opening stock, no closing stock, or if we have the same opening stock and closing stock, we will have the same profit. Now, this is important. If inventory increases in the period, what do we mean by that? If your closing stock is greater than your opening stock, that means inventory has increased. It means that if you have 1,000 opening stock and in closing stock you have 1,200, inventory has increased by 200. If inventory increases, it means that closing stock is greater than opening stock. The increase is a credit to the income statement, and it will reduce the cost of sales. Do you know that closing stock is always removed from the cost of sales? And when closing stock is removed from the cost of sales, cost of sales will reduce. When the cost of sales is reduced, what happens to profit? Your profit will increase. So know this, if your closing inventory is bigger than your opening inventory, it means your cost of sales will reduce, and the effect is your profit will be increased. And it will be bigger if we are using absorption costing method. So the total profit will be higher in absorption costing method. Now, what happens if there is a decrease in inventory, meaning that the opening stock is bigger than the closing stock? It means that what you are adding to your production is higher than what you are removing from it. The, the decrease or the difference is a debit in the income statement. And because it's a debit, your cost of sales will be lower. And if it is lower, your profit, sorry, when it is lower, then your profit is also reduced, because your, sorry, how will I put it again now? If your inventory is in the opening stock is higher than closing inventory, there's a debit, and your cost of sales will reduce, will reduce. And if your cost of sales is reduced, no, it's not going to reduce, it's going to be bigger. It's going to be bigger because when the closing stock was greater, cost of sales was reduced. When the closing stock is lower, cost of sales will be higher. And if the cost of sales is higher, your profit will reduce. That's it. Opening stock, increase in opening stock increases your cost of sales, reduces your profits. Now, increase in closing stock increases your cost of sales, and it reduces your cost of sales rather, and it increases your profits. That is what you should know. And now the profit of absorption cost now will be lower than that of marginal cost. Now there are advantages of using marginal costing and disadvantages. Advantages here includes you have a fixed cost element in your production cost, and because you have fixed cost elements, this is consistent with financial accounting. Because of that fixed element, you can get the full cost of a product. You can also calculate something called under and over absorption, which may be used in controlling your fixed cost. And by calculating the fixed cost of a product, you can compare your costs with your selling price to know whether you are making profit or not. Disadvantages: absorption costing is more complex system than marginal costing, and absorption costing does not provide information that can aid management in making decisions. Now, this disadvantage is a very important one. Now, go to marginal costing. Advantage: it is easy to account for fixed costs separately instead of apportioning it the way it is being treated of in the absorption costing method. You can account for fixed costs, can account for variable costs separately. Now, there is no under and over absorption with marginal costing. And so there is no necessary adjustment in the income statement at the end of the period. And most importantly, marginal costing provides useful information for decision making, and contribution is per unit is constant. Unlike profit that is not constant. Why is profit not constant? Because if your contribution increases and your fixed cost is not increasing, is stagnant, your profit will increase. It will not be, profit per unit will change. Profit per unit is not constant. This is because fixed cost per unit is not a constant thing. Fixed cost per unit is not constant, but fixed cost in total terms is constant. So imagine if your fixed cost is 5,000 naira and your total sales is 5,000. Fixed cost in total terms does not change. But if you want to calculate it in per unit, 5,000 divided by 5,000 is 1 naira. Now, assuming you increase it to 8,000 units, your fixed cost will still remain 5,000 in total terms. But bring it down to per unit, 8,000 divided by 5,000, you'll be getting something higher than 1 naira. So because fixed cost per unit is not going to be constant, it makes your profit per unit not to be constant. Unlike contribution that is constant. Disadvantages: marginal costing does not value inventory in accordance with financial reporting. So it is not useful in or consistent with financial accounting methods. Marginal costing can be used to measure the contribution of a product or the total contribution earned by the product, which is important. But this is not sufficient to tell us if the product is profitable. Unless the total contribution is big enough to cover the fixed costs before you can make a profit. But if you just only know the contribution without knowing the fixed cost, you will not know if this product is profitable. Now you know that some products could have contribution, but they are not profitable in the sense that their fixed cost is bigger than the contribution. So you will not know with marginal costing. Summary of today's lecture: we have learned the concept of marginal costing. We've calculated marginal cost of an item from a given data. We have seen how marginal costs and the concept of contribution are important in decision making. We have also described absorption costing using some examples. We calculate absorption cost of an item from a given data, compared it with marginal costing and absorption costing together. We saw their opening cost and closing stock. And I said again, I'm going to resolve that question and send it to you because the solution is not in this lecture. So far, so good. This is what our lecture package is for tonight. And after the recording is available, I will send the material with the recording. Later, you will get the other solution to those two questions separately to aid your study. So if you have any question, please send me a WhatsApp message and I'll be glad to answer your question. So thank you so much. Our time is well spent. Wish you a good night's sleep.